Welcome to Soar Financially, where we discuss the macro to understand the micro. My name is Kai Hoffman. I'm the junior mining guy on Twitter and the CEO of the Soar Financial Group. Thank you so much for joining us for part two of our conversation with Francis Hunt of themarketsniper.com. If you missed part one, please check either the description below or click on this info card that's going to pop up here right now to get to it. In part one, we discussed the US debt market, the bond market, and are we already in a bear market for bonds? We take a close technical look at real yields as well. Further, Francis shares with us some of two of his hottest trade ideas that no one is talking about. Assisted by technical analysis, we dive a lot deeper into the matter. But now, let's get on with part two, in which we circle back to the commodities and miners. I promise. Francis and I are going to take a closer technical look at gold together as well. Don't forget to hit that subscribe button, it's right there. Leave a like and engage with us in the comments. It helps us tremendously to continuing to bring on some of the best market commentators. Thank you so much, and now let's get on with the program.
So let's talk precious metals. So on the charting side, we see. So I've got good news for the precious metals people. You actually are having just a rest. You have to be as patient as a monk to be in the gold and silver markets, and generally people have been. Sound money and fundamentals, sometimes it takes a while, and these people have been able to extend the perversion finance for far longer than many actually expected. But if we just take a look at where we are technically, and this is again a very well annotated chart. It might be a slightly messy and overwhelming, but if I just bring you where is the take on gold, this is where you're at. You've had 3 knocks on the door and you're having your lightest and finest pullback. So I'm going to share chart again, and we're going to just go into the gold.
Now, interesting. Like, if you want to hint at like sentiment as well, maybe some volumes, how that sort of fits in, I think that'd be fantastic.
Our take is this: that you had a key breakout here on a flag. And what typically happens, we split the flag, we call it a splitter, it's a midpoint. What typically happens when you have that is you have the first test back. So this is a very bullish flag. And so the good news for the metals is the pole on this that goes off the screen takes you just short of $3,000, $2,905. But however, when you break a key capping descending grind line such as this, and you churned a little bit on that level, you have a little bit of a pullback. It's very typical. Now, I want to highlight how this pullback is slightly different to previous pullbacks. So if I just take those all off, you had a blow-off pullback here, very big shooting star. This in technical analysis is called a shooting star, where you failed to hold on to most of your move. It also was slightly lower and a second attempt at a new high, which failed. And you had a substantial pullback on that. This is not nearly as extreme. So you will experience some element of pullback, but it's going to base out a lot sooner. And the move from here has been consistently up and steady. And actually, it was slow into the highs, whilst this was a blow-off run into the highs. So it's the third time. The next one is the one where you hold above this level for good, in our opinion. So on the horizontal scale, many people will draw the 2000 mark and say, well, you've never held the 2000 mark apart from a wick on the monthly. You've never had a close above the 2000 mark on the monthly. And our opinion is that's coming around, and you'll come from a much higher base. And then what was once resistance turns very strongly into support. And that then is your foundation for further upside. So that is very bullish.
Francis, can you give our viewers, just because looking at this chart, like what is the floor that you're looking at here? Like a technical marker, I think it's 1915. I've been hearing that, like where the line is. Like if we break below 1915, we could see lower lows again. I'm just curious, like marks to look for.
A lot of analysis on the upside here. You could see we got final extra little targets that captured these tops here. And since then, we got a downside move that had a downward target down here. And since then, we've been on this thick red line, which is what we call the capping descending grind line. And you've clustered around this. It's a very dead zone. You could slip a little more, but this candle right here is a bit of a hammer candle, which is showing that it's been bought back up, and it's at a technical level we expected that to happen. So you're getting a buy back up. So you're churning. It's disinteresting. It's soft, but it's actually not capitulation. The problem that we have had is actually silver has been softer still, and I'm going to just pivot you. So in terms of this, I think you're going to have a dull next 2 or 3 months. I think September, whenever all the traders are back on their desk and the central banks are all working and had their summer holidays, you see more disbursement of treasuries. You see, and you referred to a lot of bonds that have to be issued by America. There is a lag on their interest payments. The year of 2024, given the interest rates that they have had, the payments they're going to have to make in 2024 following the interest rate spikes are going to be vast. You're going to see real dollar weakness because there's going to be a lot of proliferation and a lot of interest that has to be paid. So September, as the market is a discounting mechanism 6 months ahead typically. So it is pricing in September what's going to be in Q1 of the following year. And that's where people start to focus again on the dollar. So we refer to anti-fiat. King fiat is dollar and king anti-fiat is gold. And when the dollar is weak, the gold understandably is strong. But Bitcoin also gets a bit of that benefit in the crypto category. He's the king in cryptos, but he's subordinate to the king in gold. Silver is like Ethereum, as you were referring to yourself, but a higher beta version of this. So we are going to have a gold run going into the Q4 of this year, starting the end of Q3 into Q4 of this year again. And we will take out this high, in my opinion, a fairly high conviction. And we have that rest point of $2,900 at the fulcrum of 3K, which could see a technical run, a blow-off run through 3K and then a churn. That's going to be psychological. And I want to highlight just on a bigger...
Francis, before you move on, I have one question that popped to mind just looking at your chart here as well. I just overlaid the DEUTSCHE with the gold price. And just the last, let's 8-9 weeks here, they moved in parallel. If you look at it, so I'm looking at the charts here. So that's intriguing to me because what does that mean?
Well, what it means is dollar weak is good for gold generally.
Yeah.
And actually, euro relative strength, ironically, is supportive for Bitcoin and gold. It's a current irony. So the dollar is actually the one that is the only currency at the moment that we haven't yet, of very few, that we haven't yet made recent new highs. So the original high was the high here at 3rd of August 2020. That is still your final high, and it's 20,075. You had 2 tests. So the world is focused on the gold dollar. And we've had a disproportionate period of dollar strength. Before this weakness of the dollar, we had the dollar index run up to 114. During that period, gold made new highs on the pound, the euro, most currencies, the Australian dollar, the yen, definitely. So I will show you quickly those charts. But before we leave the dollar, I want to highlight to you how the round number of 1,000, this is a key rule of HVF method, our particular approach to technical analysis. You had, during these years, over here, a sustained period, a sustained period below 1,000. You had to build up a massive winding structure. Doesn't look large now because I'm trying to fit a lot of data on here, but that was a very significant technical event. We called for a massive breakout in gold during that period. That was the post 6, 7, and 9 period. Massive squeeze. You had the sell-off that was the reaction to 2009, that everyone rushing into dollar for safety reasons during that time. It had more cachet for safety at that point. So the point I'm making is $1,000 was technically significant. You took a big wind up to get there. Now you are at $2,000 and you're having the exact same thing. This projection of the bear is 3,000. It doesn't look as far because we're on a log scale chart. But the point is, the key round number of the thousands is going to be headlineable. And the bankers do not like that. So it's the point of rest every time. You've been knocked back 3 times on the dollar, and the dollar price of gold is the most quoted price. It's the most conscious thing. So when it wins finally against the dollar, it's won everything, because it's already won on the gold euro. It's already won on the gold pound, more recently making higher highs. So, I mean, and you can see the 1,000 level, what a long wind up period. And when you break the key 1,000 level, you go into a sustained run. You literally went from 1,000 to 1,927. You literally made the next 1,000 in a single bull move.
That's massive.
So,
yeah.
So your patience will be rewarded on the release of this 2,000 when we finally get it. And you will charge, and possibly faster than is typical, because you've had a sustained period in terms of time. You've had a sustained period sub the 2,000. You're at 1927 at 2011, and you're at the same price some 13 years later, 11 years later, 12 years later, call me a liar one way or another, but you're at the same price virtually. And we've had a proliferation of trillions. You could actually have a very short spell at 3 and go straight to 5 with a very small pause at 4. In other words, there's catch up. There is real catch up in metals to play. And I'm going to add to the metals bullishness theme by bringing in the gold silver ratio, if you'll allow this. Jump in with a question, and I'll...
No, that could be interesting, the gold silver ratio, because as we said, silver a little brother, and I'm not sure what the ratio is, 85, I think, right now, somewhere around there. Don't quote me exactly. It's not, shouldn't be too far off. But I'm curious what your target range is, because there's the idealistic target ranges of 1 to 10 or so, or 1 to 13 was or even 1 to 3. I keep forgetting what the historic average, or the very historic, prehistoric averages were. But...
well, at the moment, if you talk, so we've spoken to Jim Rogers recently. We were interviewing him last night. If you speak to Steve Newmeyer of First Majestic, they only get 8 ounces of silver for every ounce of gold they find. So the gold silver ratio, it's typically mined at 7 or 8 ounces level. And it is a unique, and it is deeply part of this required for this green agenda that we are being exposed to. In all its fashion. So there's a lot of lines on here. Let me just introduce the concept slowly, because it might overwhelm. We have 65 in our view, which is a seminal level. Remember what I said about the end and the turning of the debt markets. These things go hand in hand. This is why we are the macro guy. The turning call of the debt markets is the turning bull call of the gold silver ratio, because when the debt markets spiked in value and the yields collapsed, you had the hugest spike in gold silver ratio. It's your blow off finishing high of 128. You're actually asking, you're pulling these things out at 8 silver ounces to 1 gold ounce. You're asking for 128 silver ounces for 1 ounce of gold. And above supplies continually on all the reports going consistently down. Jim Rogers, as I said, he says, yes, gold good, but silver, when it comes, it's going to come so strong, so hard. It's going to be a beast. So in essence, it's our opinion that similarly, you're having a macro head and shoulders here, and we're on the right shoulder on the downside. That's what I'm drawing for you. This is your 65 gold silver ratio-ish, round about there. And it's our opinion that when you break down out of this structure, we call this a broadening structure. It's not a bullish structure. It's broadening. That's why you see that. It's like a trumpet, a megaphone, and it's on a downward selling pole. I should maybe have used a different color here, because this is Picasso's getting a bit interesting for people to follow. But this overall pattern is not bullish. And the sell-off momentum, when it does sell off, was brutal. So we're expecting this to go up and then to come back down. And when it releases and breaks this basing lower grind line, where I'm putting all these blue lines, when it breaks there, its next move is to the 65, where it will again pause and bounce. So it's at around 85. That's a drop to 65. Our anticipation is that is going to coincide with the 2,900 run on gold. So that major move is going to see silver move accordingly, that you'll be at about 65. And that will be your neckline rest before you finally let go and you make the full head and shoulders target way down here, which is at 32. Call it 33 and a third for ease of mathematics, because we'll be doing some maths now. So if gold goes to 2.9, let's say 3,000, blow off technical 3,000, and gold silver ratio drops to 65, what you end up with, and you can join me in doing the mathematics.
I just did the math here on my phone here, just 45.65 I got. So
100%. And let me just show you now the technical analysis. I've done this the wrong way around, but normally I show you the technical draw for silver. And let's just show that. We have a 45 target coming out of this inverted head and shoulder and this flag, $45. And what I like is when we do 360-degree analysis. We don't just get an idea and say, that's awesome, it's great, we've got a forecast. We make sure it adds up on everything. So we do the silver TA, we get a $45 projection. That's the flagpole. That line, I haven't just come out of it. It comes from the absolute capitulation. The natural geometry in charts is the degree of capitulation to the downside. The panic sellers on thin volume is the degree of the subsequent move to the upside. And that was your low. So we are seeing 45 at 46. You just did the maths yourself. We go to somewhere between 2.9 and 3,000 in gold, possible technical overshoots, might do 3,010, 300 and 3,100, who knows, and you're at 65 gold silver ratio, you're going to be, and then that makes, and the interesting juxtaposition of this for precious metals fans is this will then be the third time multi-generationally that you are at the doorstep of 50, that 45 to 49 range. That is 50. Now, I'm not sure this chart goes far enough, but let me just show you that. I'm going to make this a 6-month chart, if it just allow me the adjustment. So silver will then be, where I showed you gold has hit 3 times on 2000. This is a far larger, far more significant, far more multi-generational. I was wearing younger man's clothes when this happened. I was still in school, but I remember it. I remember Falco. We had to all do things for inflation and all of this. That will get you up for your third time to the $50 range, the $45, $50 range, where again, you will be sold off. You don't want to hear it, but you will. But the next break is the end of the game for double digits, in my opinion.
Interesting.
The next break that follows that. So you can enjoy the ride up to 45, 50. If you have leverage positions, my personal opinion is I will be taking off the leverage positions at that point. It will be judicious and low. The investment silver stays, and I will sit out the pullback, and you will get a pullback. And it may be a fair amount of time, but what comes next is going to be a bloodbath for those that don't own silver. And that is going to be your rainbow, your rainmaker trade. So if I then take you back to the gold silver ratio, where was the head and shoulders projections to the downside? 33. Well, you would possibly have gold at 5,000 at that point. I don't know how far it goes, could even be more. But let's take a conservative 5,000 by the time the gold silver ratio hits down here at 33. And if you look at that, you would then be looking at, well, that means you divide gold by 100 and multiply by 3, essentially. And 5,000 is 50, multiply by 3, you're already at $150 silver. And it doesn't stop here. Our long-term assessment for gold silver ratio is there is a chance you trade sub double digits. So there will be a chance you trade 9. Remember, you're only pulling it out at 8.
Yeah, true.
So then if you're at $10,000 gold and you're trading 1/10, 1 is to 9.99, let's say 10, and you're 10,000 gold, you're on $1,000 silver.
Francis, I got to ask you a question. I keep coming back in my mind here is volumes, because we need an indicator to see where the charts are headed. And like you've done a lot of like analysis, but it seems like a lot of hindsight analysis, and that's from me, the non-technical trader speaking, by the way. Like just looking at your charts, like with your lines, like okay, this is where it might be going based on what we've seen. But now I want to see, okay, this is happening. Do we see volumes? And you mentioned in crypto, the big boys coming back in, the big money coming in. So that's a hint for me that you are looking at volumes. My question is now, what are you seeing in terms of volumes for gold and silver right now? Like versus a few months ago, maybe when we are top ticking 2080 recently.
Sure. Happy to do volume-based analysis. We do a lot of that in our community.
Like, just to compact that, I'm curious how that factors in and what it looks like.
So you've got to remember, if gold is going up, central banks aren't buying silver. Central banks are buying gold. That's not to say they're not buying any silver. There might be, and there might be other funds statistically doing it. But the bulk of it has been China is the biggest producer and consumer, importer. And what you actually see is, so it's an interesting point, and it's not exactly your question, but there's a real interesting point. If gold is wealth, the wealth is moving from west to east. That's a simple fact. In short, if you have a trading algorithm over the last 30 or 40 years, and I have call it a conspiracy theory if you want, surrounding this, if you went long the Asian session on gold, and you went short from the London to the New York session on gold, you would have made an absolute fortune over the last 30 years. And in actual fact, if you chart the gold chart 3 different ways, you chart only the Asian session on top of it, you chart only the the London to New York session, and then you chart both. That is your actual gold price. Your actual gold price goes something like that. The Asian session only is an extreme parabola, and the London to New York close is actually a downturning.
Yeah, it's probably enough just to trade the COMEX short from 820 to 845 every day, and then go back to bed.
Essentially. and so why? Why is one part of the planet significantly hoovering it up, and why is another part of the planet managing the price back down for the cycle to repeat again? And why is this so under discussed? So you see, I search for truth. So I ask all the awkward questions. And my personal opinion, the only conclusion is it's not by accident. Something that keeps happening by pattern every single day for decades, not 1 decade, I'm talking 3 at least. There is a transfer of wealth taking place by intent. And there is some contractual. So while nation states supposedly war, they also cooperate, even if they're at war. So we've got this frenemy situation, America, China type scenario. But in actual fact, China holds probably the largest outside of the Federal Reserve treasury holding. They could destroy the debt and dollar system if they were independent minded and of mind to do so, and weren't controlled and dovetailing with the rest of the world immediately by just saying, here, have $1 trillion, and doing a not-for-profit sale and dumping the market. As we've seen happen, funny enough, on gold at late hours, New Zealand session with ridiculous sums, particularly silver markets. So hold on, why does that happen in metals markets and it never happens in the treasury markets? Because there is a cooperation. One is holding the discount window open and creating the discount window in metals. This is the only conclusion I can come to. And I ponder these things. And, I was a fan of Sherlock Holmes. My father was, to read me Sherlock Holmes. He says, Watson, my dear boy, when all else has been eliminated, no matter how absurd, that which is left is your answer. So there is a discount window being held open on account of someone holding an asset that is likely to devalue extremely, and them not immediately disorderly dumping it. And they are compensated in another way, which sees natural, and the banking systems are absolutely coerced into state and dark state and long-term government. So I don't want to blackpill and my opinions too strongly on that, but that's my only assessment that I can come to. So
it's obvious. If you look at the gold chart every morning or every day, I'm sitting here at 2:30 and I see gold getting hammered every single day. Like there is a pattern. So it's like I'm seeing it as well. Again, as you said, like I don't have an explanation for it. So at some point you got to resort to the absurdities, right? So because you run out of logical explanations. So
100%.
Yeah. Now let's quickly look at the volume charts for gold. I'm just curious how that sort of gives you an indication, or us an indication, of where things are headed or where we're coming from as well, and what kind of
I don't think it's going to be
looking
particularly interesting right now.
Then let's skip it.
Because no. When I say it's not a bad question, what I mean is I don't think you're going to find it particularly interesting volume. Because you're in a pullback. And let's go to the share chart, and I'll just confirm that with you. So no, I'm not debunking the validity of your question. I'm just saying it's going to confirm what I expect to be essentially light volume pullback. There's no conviction in the selling. And here we go. I've gone to Owanda, one of the biggest brokers, and you can see there was real surge blow-off buying on that shooting star. This was FOMO, and there was FOMO volume. And then the bear volume reduced to a certain level where there wasn't much conviction. Then the buying came in quite timidly, and we've worked up on quite normal volume, and this current sell-off is below average. This is one of the places I will justify moving averages, just to see on the volume, how much is it above or below average. And let me just go put in a moving average color-based. 1 second, apologies.
Yeah, no worries. Just curious what that would look like, because right now sentiment overall and volumes across the board, being it commodities, being it mining stocks, are just completely shattered. We see ETF outflows. Only the central banks, as you said, are buying pretty much. So
what you typically see is on pullback periods, there's low engagement, and that makes pricing invalid, typically less valid than when you have high engagement. So you look at the last falling into lows here, you can see volume reducing and then low value. And then you see where we are now. We're well below the 20-day moving average on volume. So it's a low engagement market. That means it's easier to push around, read down at the moment. But when you start to have really stronger bull buying, like over here, it's not nearly as easy to push around. You have 4 consecutive months of bull buying. It's not hard. Here you were super low engagement market, and you were near the lows. So as volatility goes down, volume typically goes down. The two vols, volatility and volume. This was our breakout bull call, by the way, and it was on exceedingly low volume here. You can see this volume was very low right there.
Yeah.
So it actually becomes a buy. If what you want to see is volume get lower and lower and lower and price get really sleepy, because low volatility with low volume is a precursor to explosive. Volatility is interesting. It's asymmetrical. It dissipates slowly. It's like this. I create a shaker blanket. If there's a flick through and there's a sine wave, or you throw a stone, or you into a water, the ripple gets slowly, it disperses the engine, larger but softer, and it dissipates slowly, but it returns with a bang. The actual impact of the stone is sudden and violent, but it dissipates slowly. So when it returns, you get a surge in volume and you get a major breakout. And my assessment is the next major move, even though you could slip a little bit on low volume in and around these levels, the next major move, of which will push both volatility and the volume engagement on the market, will be the break. And that is the final break for that level. You will revisit that 2K as a technical revisit, and then you're off and away to the upside. So you've got a boring period to sit through, and a little bit dull, and maybe a bit off during this period, which is why I'm saying to you, if you're a trader stroke investor, the yen weakness, the Nikkei long trade, and the Bitcoin trade is where you should be looking now. Come back for September for your precious metals. You also asked the question about the miners, and we've skirted that. Why are the miners lagging?
Well, it shows here in the gold chart exactly why the miners are lagging, I think. As soon as the Fed rate hikes kicked in, the miners disappeared. Risk capital disappeared. And there wasn't any money for growth. It all went value, and that was it.
And given a horrible long bear market where borrowings may have climbed and now interest rates climb, you get chronic margin compression. And when I look at cost, the energy cost, as I was describing when we had our pre-chat, for digging holes just gets bigger with inflation. So actually, precious metals price is barely off the floor of cost. It's only staying slightly above. And then when you have a debt carry and you have an increased spike in debt, what you actually have is these businesses are just still marginally profitable businesses. When they really come about is when you get at the margin, some of them are just dipping below profitability and just above, when you get a chronic surge in the price, and then you have this tipping from being marginal minor, being minor negative to suddenly very, very positive. And that can lead to, especially if that price surge seems sustainable and continues to run. So
Absolutely.
the market doesn't just price one good month. They would say, well, we've seen the price at 2,000 before. It's going to come back down. They're not technical analysts. They're not seeing 3,000. So the problem is you can't wake up faster than the rest of the market. And they are all fascinated with the new toy, AI and chips. Okay, so they're all playing there. It's like watching 5-year-olds play football. The entire team is running around the ball. You're sitting out on the left wing waiting for a pass, and you've got a clean run on the goalie. Unfortunately, the markets are as clever as the aggregate of its participants. And at the moment, this is not considered value, and not many people see. Even some of the investment banks have forecasted $3,000, but they did so 6 months ago when the gold was moving up, or 2 months or 3 months ago, and everyone's forgotten about that. So unfortunately, you get short spans of attention. And I say, play the long game, be focused on the long ball. I'm an investor in gold and silver. Silver will outperform in the long run. The gold-silver ratio will come down phenomenally. Digging holes in ground is expensive, and it's now getting harder to open new mines, thanks to all the watermelon communism that they're bringing, the green agenda. So it's only one way that it can go. Plus, it's going to get more utilized in all these new things, such as battery this, battery that. It's the best conductor of electricity, and you can't substitute and have the same efficiency. So all these things come to town, and you just have to be patient. But in the meantime, I'm leveraged long Bitcoin, and I'm making some money, and that's new silver bars for me in the due course. And that's how building your wealth in reset time, which is our core theme of our community. That's how we choose to focus.
Fantastic. Francis, perfect summary as an end to our conversation here. Really, really appreciate it. It's very in-depth, as we said before during our conversation. This is part 2 of it. Part 1, we discussed Bitcoin and, of course, the Japanese market, yen versus Nikkei pair trade, and how that all works. So please tune in for that. Francis, where can we find more of you? Super insightful. Where can our viewers find more?
First of all, just to catch something that we do for free, it costs absolutely nothing. Go to YouTube, The Market Singular Sniper. So there's one S in there, or The Crypto Sniper. I separate the two market categories. Follow us there to engage and potentially have a chat about our community and joining that. You're welcome to book from themarketsniper.com to have a chat. Costs nothing. We give 14 days money back. We're a community of the willing. We've got members for 6, 7, 8 years. We also look at the reset element, some of the aspects people need to be thinking about government overreach, protecting your wealth, and other aspects like that, which we haven't delved into today, and I won't get into here, but people can look into that. I sincerely suggest that they take some steps, regardless of who they choose to use for that, in terms of protecting themselves. And it could even mean being a bit more fluid and mobile. I live in 3 countries, and I don't feel good about the West as a whole. And the point is, we're like boiled frogs. We often wait until we're literally being boiled before we move. Move soon, plan. There's plenty of time. Take preparation, keep your mood up, and look at these current markets of great interest, and we enjoy seeing you on the YouTube channel. Thanks for having me on.
Fantastic. No, Francis, great conversation. Appreciate your time. It's been in total, it's been an hour and 15 minutes. So really, really appreciate that. And everybody else, thank you so much for tuning in. We hope you enjoyed this conversation. As we said before, Soar Financially, we discuss the macro to understand the micro better. How can we become better investors? What makes us better? We try to understand and have a holistic approach. That's why we talked about Bitcoin today. We're not a Bitcoin channel, but it starts to figure out and help us understand what is going on a global scale. Where are the opportunities? We hope you understand what Francis's points were, and we hope you like the information presented here. This is, of course, not investment advice. You all know that. Read the disclaimer below. We're not going to go into that, but do that. Subscribe to this channel if you like the content. Use the comment function. What do you think is going to happen? How are you protecting yourself? How are you thinking about gold, Bitcoin? Put that all in the comments. I know we're going to get a ton of them because there's 2 camps. It's rare to see the middle ground, but Put that in there. What do you think? What are you trading right now? When do you think gold's going to pick up again? Do you like the miners? Put that in there. Again, subscribe, like, help us get the engagement up. That'll help us grow our channel and get guests like Francis back on here. Thank you so much. We'll be back with more.